Hello, welcome to S7FX. So today I will be starting the next episode. But before I go to the next episode, as I had already told you guys that I will be doing all the previous exercise before continuing, because there are 40 videos for the 2022 mentorship, and if I will watch like 3 hours per day, I will be easily able to finish it in 10 days, like less than 10 days. Okay, but my goal is to not just finish that video, because it is not going to help full if you just finish that video in just 10 days or 8 days. Okay, so if I want to just get the entire thing in a good way, or just want to learn that thing by heart, I have to do the practice also. Because if I will not be doing the practice of that thing, because the concept is itself a very vast concept, so I need to do the practice. So when I finished my live session yesterday, I went to the notes. There is a channel, the name of his channel is Braveheart. Okay, and he provides the notes of ICT. Okay, and when you go to the notes of ICT, you will be seeing like this guy has almost recorded each and every like words what he had said in the episodes. Okay, so that is a good thing. Okay, because when I go through his notes, I found that I have missed a lot of things, so what I did, I just like first I completed all my video lessons. Okay, and when I completed my video lesson, I just read my notes which I made on the live stream, and then I started making the self-learning notes. Okay, in self-learning notes, what I did, I just go through his notes and find out the thing which I missed during my stream. So yep, I have left the gorilla trading since January. I have left it. So I tried to make the notes, but unfortunately I had some work, so I could not complete the notes. So it will just take, I think, 20 minutes to just finish the notes. Okay, because I have already completed like 9 pages. These are just some other pages. I will be discussing all the things. Okay, all the things in these notes, and I will be just trying to understand these notes. Okay, I have already understand it, but I just want to, if I am giving a 3 hours of learning, then I want to just give it a 3 hours of learning. I'm not in a hurry to just complete the video, watch the video and just finish the course as soon as possible. If you will not be learning each and every lesson, then there is no benefit of giving you 3 hours. Thanks, Dennis. Thanks. So I was looking at this concept. Okay, so here what it is well structured notes. Okay, it is very well structured notes. So the thing is, I've already studied all these things. Okay, so I will be starting it from here only. As in the third episode, the ICT mentor said that we will be looking for a liquidity grab on these areas. Okay, the high and low of Asian session, high and low of London session, high and low of New York session. Okay, and there were also the areas where we can see market structure break or chop or bullish market structure shift, all these things. So these will be areas where the any old or an old low or a clean low, you know, we have to consider this thing, a old or a clean low. What I have seen so many times that people try to the notes where you can just go to the channel and just let me just open his channel. Let me just open his channel. I can just show you that channel. Yep, this is his channel name. When you go to his channel, you can, let me just mute it. You can see link to the study notes PDF. When you will be clicking on this section, you will be getting the notes, all the notes. He has made the fantastic notes, believe me. Okay, he has mentioned each and every word whatever the mentor has taught on his thing. Okay, so it is very beneficial to first watch what his content, go through your notes, what you have made, and then go through his notes. And once you do these 3 steps, then you should move to the chart. Okay, and on the chart try to implement those things. I know that when I will be start doing those things on the first hand, I will not be getting a good result, but it is just to build the basics. Okay, once you will be able to build the basics, then we will be move forward. Okay, let's just I have just started to make these notes. Okay, see, if somebody wants to know what I am doing, so here he has already, if you go to the upside, first he had talked about the difference between market structure break and market structure shift. Okay, so basically what he said that a market structure break is a prolonged movement of multi-day time frame. Okay, and market structure shift is basically a smaller thing which can happen in a intraday point of perspective. Okay, the market structure shift leads to an intraday drop. Okay, intraday liquidity pools or intraday fair value gaps. So we can see that the market structure shift can happen in intraday session. Okay, but market structure break, we will be looking at the market structure break on a daily basis, but we will be looking at the market structure shift on an intraday basis. And where we will be looking for that market structure shift, we will be looking for that market structure shift on this naked HD. What I don't know why he used to spam my channel. If somebody wants to make a girlfriend, here we have someone who is providing a girlfriend. So see, here the first thing that he taught, that market structure like market structure shift can happen like in a intraday basis, and market structure break we will be looking it and on a daily basis. Okay, on a higher time frames. And where we will be looking for a market structure shift, we will be looking for a market structure shift on a particular price point. And these market structure shift we will only be looking these market structure shift in these areas. First criteria to look at the market structure shift is an old low or is at a clean low. Okay, or bearish market structure shift, we will be looking it as on a old high or on clean high, bearish market structure shift. And also there are certain like Asian session high and low, London session high and low, and New York session high and low. Okay, intradays high and lows before equity open. So you know that there are equity sessions also, like NYSE, New York Stock Exchange open. So at 7 p.m. IST and 9:30 a.m. EST, equity session open. Okay, so we will be looking for a New York session high, which is foreign exchange session. We'll be looking for New York exchange high and low. Okay, and here it is clearly mentioned that these intraday highs and low before equity open. Like let's suppose if you go to an hourly chart, okay, and if want to look at the intraday high and low, so these will be somewhere at around, because you know at 7 p.m. we will get intraday NYSE open. So we will be looking for our market shift before that only. Okay, so this will be the high. Just give me a second, I am having a call. Sorry about the interruption. So here what he wants to play, intraday high and low before equity open. Okay, equity session open. So here what I am looking, this is the high. If we just remove this candle, so this is a 7 p.m. candle. So we will be looking for the high and low before the equity session open. So here the equity session has not, like before the equity session, this is our high and this is our intraday low. Okay, if you go to the previous, so see at this area we are having this is a low, equity session low. So if you look at this, let me just hide it out. Okay. So when I hide it out, here we are seeing a 6:30 p.m. IST candle, and after this candle we will be getting our equity session. So before the opening of that candle we will be marking our high and low. Okay, because you know it is very easy to know all these session high and low. Okay, London session high and low, we can easily mark it out. we have several indicators to mark these highs and low. Okay, so we don't have to discuss about those highs and lows, because let's, if you want to make a London session high and low, this is our London session high. Okay, this candle is our London session high. Okay, this candle is our New York Asian session high. Okay, this is our London session low. No, we have not closed yet. London session has not closed yet. So here we can see that when the equity session open, we saw that we get some sort of shift in the direction, shift in the market. Okay, when the equity session open. So we will not be looking for these shift at a random places. Okay, but here we are having an intraday high and low. If you go to the like 4 hour or 15 minute, you will be getting this intraday high. This is the high of 29th July, and this is the low of 29th July before the opening of NYSE. Okay, so before the opening of equity session, this was our low and this was our high. So this is an area where we can look for the market shift. This is an area where we can look for the market shift. If you go to a lower time frames, then we will be looking for some market shift in these areas. Like, see, this is the high. So once the market breaks this high, we have our market shift. Okay, market structure break to the upside, because this is a range. I would say, like, the market is, for me, market is moving like this, and this candle has just given us that market shift. Okay, and then it just continues its move to the upside. So this is just this is not a proper example, but I'm just trying to find it out, like how I can see the market shift. How I can see the market shift at an area where the ICT mentor had taught to look for market shift. Okay, so I was just looking for the market shift in these areas, and here we will be looking for fair value gap or imbalances. Okay, so this is just a vague, like, this is just a 1 and 2 episode, like a crux of one and first, like second and third episode. And here you can see what he's also trying to teach us, that, see, I took the example of intraday high and low before equity open, and here the Braveheart notes, what he's talking about the sell side liquidity New York low, which the Michael has already taught us that we will be looking for market shift on a high and low of New York session. So this is the New York session high. This is the New York session low, and when the market dipped in this liquidity pool, okay, we will be expecting some sort of market structure shift. We can see that this is anticipate and a market structure shift. Okay, so here in this example, I told you to look for the market shift. Look for the market shift in a intraday low, and in this example here, the Braveheart notes, like, I don't know whether this notes was it was his example or Michael had given this example. I don't remember, but he's just giving us the second example. The New York session low, market just reached this New York session low. He is anticipating a market structure shift, and on the next slide we can see that the market has just break this high, as I saw as in our example also. The market has just broken this high. Okay, market has broke this high, and then we will be finding some fair value gap in these areas, okay, so that the market can reach to these areas and we can take our entry in these areas. Okay, you can see on a lower time frame, this is a 5-minute time frame. This was a 5-minute time frame also. Let me just look at it. Okay, so here it is showing the market structure shift. I don't know why he recent break of high. Huh. So once the market structure shift happens, it has started to seek opposing liquidity. Okay, once this happens, it will start to go to the opposite side liquidity. Okay, to grab the opposite side liquidity. And now we can see that here we are seeing some sort of bullish example. Sorry, I was having a mystery was on my door, so he just wanted to ask something. So I was just explaining him some about something. So sorry about it. I don't know how much time it will take to just construct a house. It is a very headache process. Uh, so here I was talking about the market shift. We saw that the market has just broken this market structure. Okay, see, if I say the market structure break, so I'm just talking about the intraday perspective. I'm not just talking about the daily perspective. You know, on the daily perspective, the market may be to the downside or maybe to the upside. Okay, but when the price reach to our area of interest, okay, when the price reach to our area of interest, where on an intraday basis we will be looking for a market structure shift. Okay, and if like our intraday bias is like down, the market structure is down, okay, on an intraday time frame, and our uh, area of interest is also aligning with the market structure, and then we get a market shift, then the probability of running that trade will be definitely much higher. And here we can see that it is clearly written that the price does not need to close above the most recent high. Okay, so that's a thing which we have to keep in mind. Like here also, here we get the break by closing of the candle, but if we don't get the close, or if we just get a wick like this, then also we will consider it as a break. So this is the thing which is already written, that when the candle closes, you want to see if a fair value gap printed. So when we get a market structure shift, we will be looking for a fair value gap, and once the market goes to that fair value gap, we will be taking our trade. Order blocks are the down candles prior to the market structure shift. So these are the down candles prior to this market structure shift. Okay, so we will be looking for that order block also, fair value gap, and then the order block. Then we expect price to reach towards opposing liquidity. So these are the opposing liquidity. Okay, once the market start moving its move, we will be expecting the market to reach to the opposite side liquidity. So we are also trying to apply this premium and discount concept. Market is right now in a discount zone, and then we will be looking for our exits in a some sort of in a premium zone. Okay, So these are the areas where we can look for a partials. Some partials at around this area, we can see some partial, we can take some partials at around these areas. Okay, because these all price points are on a premium zone. When the price point, or when our price reaches to the premium zone, we will be looking for a liquidity area, and there we can look for some exits, some partial exits. So that's it for the episode 3. Okay, so right now I will just keep moving for the next episode. Right now I will be moving to the next episode. Yes, Arjun, I saw your recent video with the Wonder Kid. It was a nice video. Okay, so let's start our next episode. Thanks, Arjun.
looking at some examples since I showed you what we're looking for on Tuesday night. So Wednesday's trading and Thursday's trading, we'll take a look at that. All right, first up is the E-mini S&P March delivery contract for 2022. Wednesday, January 26th. I want you to take a look at this low over here. Okay, and don't just use my charts. You want to look at your charts and go through it from your platform, your broker, whatever feed that you're using. This is TradingView. It's a free charting package when it's end of data. But if you want to have real time, I think I'm paying $4 a month for the data. It's not really expensive, but you want to have the low over here on Wednesday the 26th. And you'll see why I picked that low there, because it's the low. Okay, then this is the high. So we have this price run from this low to this high. That's our range. So you want to drop your fib on that. Now get your equilibrium price point. So as the highs were ran through, we have that run up. The market gets pushed into a premium. It's really expensive. And then we want to wait to see, does it break down below the old high? It does. But does it create a fair value gap in here? No. Then it rallies one more time. Then breaks down again. Inside here, there's a break in market structure. You see it here. Then it runs back up into the fair value gap here. And then sells off, reaching into this old low, which would be below the equilibrium price point of this entire range, or 50% level on the fib. Okay, put some lipstick on this. Again, here's the low and the high, equilibrium, which is a 50 level on the Fibonacci. So we're looking for a low or an imbalance below this level. Okay, so we'll swing low here. We have an imbalance here. That could be a target. Notice how we hit it there and came off of it. More pronounced low here. And drills down into that. So inside this shaded blue area, we're going to take a closer look at the details. Okay, we're zooming in a little bit. Again, still on a 2-minute chart. Previous high, short-term high. And 8:30 in the morning, that starts the hunt, basically. That's what 8:30 in the morning is to me. So we're looking for an old high to be violated. It does here. Then it breaks. It's a break in market structure. Swing low.
So here what Michael wants to say that when we were looking the notes, let me just open the notes. So in the notes we can see that we will be looking for intraday high and low. Okay, and there we will be looking for the market structure shift. So the same thing is doing right now, the same thing what the Michael wants to giving us example. So I can relate these things, and I just want to highlight it because it is important. Because see, if you go to the previous, then we had a previous low and we had a previous high. Okay, this was a high, previous high. Okay, so now the market just reached this area, grabbed the buy side liquidity, and then we saw the market structure shift. And when we got this shift, we saw some sort of fair value gap. If you look at this candle and this candle, we had a fair value gap. Okay, so
the equilibrium price point of this entire range, or 50% level on the fib. Okay, put some lipstick on this. Again, here's the low and the high, equilibrium, which is a 50 level on the Fibonacci. So we're looking for a low or an imbalance below this level. Okay, so we'll swing low here. We have an imbalance here. That could be a target. Notice how we hit it there and came off of it. More pronounced low here. It drills down into that. So inside this shaded blue area, we're going to take a closer look at the details.
You can get that PDF on a channel named Braveheart Trading. You can see this channel, Braveheart. So you can get these PDF from this channel, Braveheart Trading. This is a quite good channel if you want to learn ICT. So this channel is very helpful if you go through this channel.
Okay, we're zooming in a little bit again, still on a 2-minute chart. Previous high, all-time high. And at 8:30 in the morning, that starts the hunt, basically. That's what 8:30 in the morning is to me. So we're looking for an old high to be violated, which does so here. Then it breaks. There's a break in market structure. Spin low. There's a candle over here. That sets the stage. Now you have an opportunity. Does price draw back up into the fair value gap after this candle breaks below here and giving you a bearish market structure shift? Yes, it trades up in that fair value gap. You can go short there. And again, you can target this old low here or that low that was annotated before we zoomed in. And look at the beautiful delivery there. So hypothetical short from here and hypothetical cover here. You would log that in your study journal. Don't use my examples here alone. Go into your own charts and annotate them as well. So shorting around, we'll say 44.19 and covering at say 43.82. Just to be not perfect. That's the opportunity of the range, but you don't have to have all of that. It's still a very, very nice delivery based on the logic I taught you on Tuesday and the first lesson on the previous week's Friday. Again, there's that fair value gap. And that's your candle delivery.
Hey, it's Tony Robbins. I got a question for you. Who wishes they invested in Tesla before electric cars started becoming?
Consider it as an ideal entry. And you discount hold low as a target right there. So your charts will look just like this. In any open space like over here, you would just type in whatever important factors that you found insightful about this example. How long did it take? How long did it take from the market structure shift occurring? How much time did it take to get up into the fair value gap? That's real important. How long did it take before it went from your entry down to your target? And time. How much heat or drawdown would you have weathered getting short?
So this high is basically the high just before the opening of the equity session. Okay, this is the high of the intraday before the opening of equity session.
Now, if you use
And once the market reached that area, Michael just wait for the market structure shift, and he just took this trade at around this area.
this candle's high as your entry point, you technically could have filled here. But in here, I want to teach you to look at the total range available in hindsight, okay? Because it gives you a framework to look for how these examples.
I never learned this on SMC. That in SMC we used to work on market structure. Once we get the market structure break, we draw our point of interest, and from there we used to take the trades. But here we are looking for the like intraday high and low, London session high and low, all those sort of high and low. But I remember that in SMC I never learned about taking high. In SMC we only used to take the old low and or a clean low high break as to get from where we used to look the point of interest and where we used to look the market structure shift. But here in ICT, what I'm seeing that the Michael just trying to say that if we are having a intraday high and low before equity session open, okay, and we also have an NY session open high, like high and low, and London session high and low, Asia session high and low. These areas are the liquidity areas, and if the market, we see any sort of market structure shift in these areas, we will be looking for our opportunity in lower time frames. So that's interesting. I have not back tested it yet. Like, right now I'm not an this is just my second day, and I'm not at a position to just do a back test. But yeah, I can do a forward test where just I can just see the charts, okay, without doing any sort of back testing. I just want to mark all the I just want to train my eyes whether I can see these things or not, or whether these things happens also or not, because it is very important for our mind to understand that whether these things happens or not. We have to just convince ourselves, and we will be convinced if only we will be looking all these things just
While they're not exactly the
by
same, they
ourselves.
don't repeat exactly a photocopy of every single previous instance of it. There's a lot of similarities that you'll find that are recurring. And that's the important factor, to train your eye to see it. Remember the analogy I gave you on Tuesday night about the deer track and being a hunter? You have to know what a deer track looks like. You have to know what a deer track is to stalk it effectively. Well, this is your pattern and setup, so you need to go in looking for it. So it reinforces the idea that you know what it looks like. All right, we're looking at the E-mini NASDAQ futures for Thursday, January 27th, 2022. This is a 5-minute chart. This is the time frame you start with and you work down, okay? So in the 5-minute right away, you can see the low, the high, and we're looking for the high, and go back in time in your chart. You'll find what this is here. But you have these relative equal highs as well. That could have been the initial objective, looking for these relative equal highs to be taken out. And does it break down and give you a fair value gap? No, it doesn't. So it wouldn't meet the criteria there. I know some of you might be looking at it, well, how do you know it doesn't get you in a trade here? Listen to the rules I gave you. They're very specific, and that's what I'm walking you through here. That way you can see it's kind of allowing the market, or really forcing the market, to show you its hand. Once it does that, then you can go on and act accordingly. But you have to wait for the setup. You can't force it. You can't think it's there, or it's not. So we have old high here, buy sell liquidity resting above that, and we have a run above it. Once it goes above here, does it go above it and break down and then go down below that short-term low there? No, it goes higher. So we just keep waiting for a break lower to get a shift in the market structure on an intraday basis. We have a swing low here. It trades down through it on this candle here. So right away, at that moment, when this candle, as soon as this candle trades through it, you now have an opportunity. Then you go back into the high to that candle, slow, and do you see a fair value gap? It's right there. And this market rallies back up, trades into it here. You can be a short seller there. The market breaks down. One more time, we trade back into it and reaches below the equilibrium price point. It has a couple targets here. You can be here, or in the imbalance. And it hits all of them and goes a little bit further forward. All right, so that was quick, hopefully painless. And again, we're looking at internal rates, liquidity, and market structure shifts intraday. My advice is for you to go back through more data, use the weekend that's coming, and acquire more of those examples that we can include in your study journal. Next week, I'll work on targeting, refinement, and entries. So I'll talk to you then. Enjoy your weekend. Be safe.
टेक्निकल एनालिसिस यूज कर रहे हैं फिर भी प्रॉफिट नहीं हो रहा है, मूविंग एवरेज यूज कर रहे हैं प्रॉफिट नहीं हो रहा है,
All right, folks, welcome back. This is the 2022 ICT mentorship on YouTube. And this lesson is going to be intraday order flow and understanding the daily range. All right, folks, we're looking at tradingview.com, and you can use this platform for free. There are some benefits to having a membership there. It's not terribly expensive, but nonetheless, it provides you a means of looking at charts that I show in my mentorship here and in my private mentorship group. So it's the same charts that I'm producing for that community that I'm producing for you as well. Everything in this lecture is going to be predominantly around teaching you the elements of the E-mini, setting up your daily range and your intraday layouts, and I'll talk a little bit about daily profiles, so that will help you. And I'll compare and contrast and showing you what it is that you're trying to learn from me here versus what is available out there on the internet. Okay, so that way you can decide whether or not this is going to be a worthwhile pursuit for you. These things that I'm teaching today are directly linked to index features, okay, like S&P, NASDAQ, and the Dow. Okay, you can use the Russell 2000. Those are the markets that I'm targeting with the lessons. The ideas of trading the Asian range and things like that, they are not applicable to these markets. I don't teach that to my students. I want you to just focus on the things I'm going to show you in this mentorship. All right, first things first, I'm going to get the boring stuff right out of the way. Whenever you're looking at futures, especially the index futures, these contracts trade with expiration dates. And the months that they trade are going to be shown here. ES is the symbol for E-mini S&P. H in this example stands for March. So the delivery month codes for the commodity markets, H is always representing the month of March. M is June. U is September. Z is December. These are the only 4 months that the index futures trade on E-mini S&P, E-mini NASDAQ, and E-mini Dow. Okay. The year, obviously, is what it is. Now, if you're going to be using, like, for instance, when I take live trades in the TD Ameritrade, they don't take their year symbol like this. It's Q2. But in TradingView, if you're pulling up the symbol, like I have here, ESH2022, that represents the E-mini S&P 500 contract for delivery month, March, year 2022. Okay? Since they expire, it's important for you to know that the third Friday of the month of delivery, which is obviously in this example here, March, the third Friday of that month is expiration. And you do not want to be trading after expiration. And the question is going to be is, when do I start trading the next month out? Okay, this is always going to be the front month or the current month or nearby contract. The month after the front month or current contract month, it's always going to be referred to by me as the next month out. If you ever have a doubt, you can go to barchart.com and you can go to the select commodity tab here. This is all free. You can scrub down into this list here, go to S&P 500 E-mini, click on that. It'll open up what I just showed you there. And the first one, that's the cash. You don't want to look at that. The next contract available is March. Yeah, usually a little cheap. Right now, this is considered the front month or nearby contract. The open interest is what I'm watching. Okay, so 1 week before expiration, which is the third Friday of the delivery contract month. So third Friday of March, third Friday of June, third Friday of September, third Friday of December. Roll over to a new year. It starts the sequence all over again. March, June, September, December. Real easy pattern, real easy means of keeping track of where you're supposed to be at. But usually around the first or second day of the week prior to expiration, I start monitoring open interest. And I want to be in the month that has the larger open interest number. Notice that the June contract only has 57,310 contracts of open interest. Right now, front month or nearby contract of March 2022 has open interest of 2.2 million. So this is the larger liquidity base contract month. So I'm going to be trading this month. If it becomes a matter of this month here has larger open interest, than this one here, then I'm going to be trading the next month out because I want the liquidity that's available in the larger pool of liquidity offered by the most traded contract month. And so hopefully that answered that question. I have a lot of questions regarding that. All right, so now what we're looking for is an opportunity, and I'm going to teach bias and specific entry techniques next week. This week, I'm teaching you the intraday framework, and I want you to start thinking about market profiles and the homework assignments, obviously, for that in this video. But we're going to assume that you were bullish in here, okay? I'm going to provide proof in this video that I was bullish, and I did execute with that bias in mind, but just kind of put that to the side. I know some of you are very anxious and you're leaving comments saying, can you teach me how to get in? You know, what am I looking for? I understand your excitement, but take the lessons at the pace that I'm giving you, because I'm giving you homework assignments and studying. So that way it helps build and ingrain the understanding I'm giving you. Because your study time is actually going to be where the majority of your learning is going to come from. I'm just giving you, points of reference so that way you can go in and start looking for things and start seeing a reoccurring, repeating phenomenon. But I want to take a look at the 15-minute time frame.
If you don't want your S bank to become no bank, you need to watch this video.
And when you're looking at this 15-minute time frame, this is the bellwether time frame. This is where I'm looking for key highs and lows. I'm looking for imbalances like fair value gaps and things of that nature. Yes, I'll look for order blocks, but I'm going to try to stay away from order blocks in this lesson and in this mentorship, really, because I have models that don't even rely on order blocks. Obviously, I'm teaching fair value gap here, and that is the main focus because it repeats. It's an easy pattern. It's there a lot. But I want you to think about how you frame your day. So when you're in TradingView, or you can do this in your own platform if you're not using TradingView, but I'm recommending you, at least while you're going through mentorship, you're on YouTube, to go through the process with TradingView. And this is what you would classically see annotated in my chart for a Forex setup. I'm taking you to 8:30. Okay, I'm going to put a vertical line here at 8:30. Put this clone. I know this is very boring for some of you, if you really want to just get in there and get the nuts and bolts, but I have many people watching the same video, so I have to make this as complete as possible and try to cover all the bases, and then hopefully I don't get as many emails because I can't keep up with them. And so if you email me and I'm not responding, I apologize, but I can't keep up with it. And so, all right, so equal distance in time in the morning, then an hour lunch, New York lunch, and then an equal amount of time after that, okay? So I'm gonna zoom in here. And in your mind, I want you to think about that lunch hour, and this is always New York local time, okay? Set your TradingView chart to this. If you do that, no matter where you are in the world, you'll be able to calibrate your local time with this, okay? Everything I'm showing you is directly linked to New York local time. If you do any other time frame, you're gonna mess up. You won't have the same calibrations as all my students and what I'm looking at in price, because eventually I'm gonna be showing you charts on my community tab that I want you to be watching before it happens. But before I even start doing that, I'm not gonna create a train wreck by having everybody looking at charts in their own local time and not New York time and completely miss the point and plot. So once we have this, I want you to think of this hour here. Noon to 1 o'clock in the afternoon, New York time. That is a no trade time period. I don't care who tells you that they can do this and do that. If you're learning from me, just don't trade during that time. Okay, not even in demo, because just trust me, don't do it. Okay. As we go through mentorship, you'll understand more reasons why I just can't give everything in one video, obviously. And I want to, and I want to do 4-hour-long teachings, but I'm trying to make them palatable because I know the majority of you don't have the attention span because you're new and you're just now discovering. So I'm trying to bear that in mind when I'm making these presentations. So you have your daily range on an intraday basis, all set up and laid out. So these are your boundaries. Your morning trade is between 8:30 in the morning. Why? Because there's news events that come out at 8:30. All the way to noon, preferably around 11 o'clock. I generally don't like to take trades after 11 o'clock in the morning. Now, that doesn't mean I haven't or that I won't. I just generally try not to. I want to try to be positioned before 11 o'clock and hopefully be riding something into the New York lunch at noon. Then scoring positions or taking some off if I'm going to hold through the lunch and anticipate something going through to the close. And we'll talk about that when we get into profiles. Not volume profile, okay? The idea of the afternoon session, I wasn't going to teach that, but because I see a lot of nonsense on YouTube, I'm just going to teach it to you. Okay, so it's going to be a complete daily treatise on the entire daily range of indices. That way, if your interest is in this asset class, you'll have a far better chance of being successful, in my opinion, using the information I'm giving. Okay? And I'm proving it with actual executions, as you'll see in the video. All right, so we're looking at prior to 8:30. What are you looking for? I got a lot of questions in the comment section. I'm reading all the comments, folks. I love it because it's real short little snippets. I know a lot of my students, they like to send me these really long-winded, appreciative emails, and then they give me one chart that doesn't really explain much to me, and I can't really answer it. So the comment section that I'm opening up on every one of these videos, if you haven't noticed, I'm allowing one comment that to kind of like honor those individuals that are showing appreciation and are not gratuitously looking to praise me. I don't like that, okay? I like the appreciation for my time and energy and sacrifice given to you today, but I don't want to be worshipped, okay? I don't want all that kind of stuff. Don't call me the goat, don't call me the greatest of all time. I don't like that kind of stuff. But if you have something that you want me to touch on and improve a delivery or explanation of a specific thing I mentioned in a video, I may already have something in a future lesson planned, but if it's something that I don't have in my outline that's going to be in future videos, I'll utilize the feedback I get. Okay, so that way, I understand some of you want everything all at one time, and there's no way I can do all that in one time. But I am taking the feedback I'm getting from you all, and I'm using that, okay? But one of the questions I got was, what highs and lows are we looking for? That, a stop run would be framed on, or what would be the catalyst for a stop run? Well, prior to 8:30, if you look at that, they will just grab a horizontal array. And we see this high here, and I'm utilizing this with the benefit of hindsight, because this is how you're going to go back and back test everything. I want you to take a look at the high here.
What's up, you guys? It's Billy Jean. And before you go on skipping and scrolling, I have a quick message.
And the low right here. So let's for a stop run. Well, prior to 8:30, if you look at that, they will improve a delivery or explanation of a specific thing I mentioned in a video. I may already have something in a future lesson planned, but if it's something that I don't have in my outline that's going to be in future videos, I'll utilize the feedback I get, okay? So that way, I understand some of you want everything all at one time, and there's no way I can do all that in one time. But I am taking the feedback I'm getting from you all, and I'm using that, okay? But one of the questions I got was, what highs and lows are we looking for? That, a stop run would be framed on, or what would be the catalyst for a stop run? Well, prior to 8:30, if you look at that, okay, we'll just grab a horizontal ray. And we see this high here, and I'm utilizing this with the benefit of hindsight, because this is how you're going to go back and back test everything. I want you to take a look at the high here. And the low right here. So prior to 8:30, in other words, to the left of that, on a 15-minute time frame, what's the most significant or obvious swing high and swing low? Swing high is this. It's a candle with a lower high to the left of it and a lower high to the right of it. 3-candle pattern. Okay. It does not matter if the candles are up or down closes. You're just looking for a swing high, because above that's going to be buy side liquidity or buy stop, and a swing low prior to 8:30. That's a candle that has a higher low to the left and a higher low to the right of it. It's 3 candles. Again, it does not matter what the close of the candles are. It has absolutely no bearing on what I'm showing you here, because the swing points are where liquidity is going to be placed. Okay, so once you have these levels on your chart on a 15-minute time frame, then you can drop down into your first lower time frame for entry. That's your 5-minute chart. So let's do that now. All these things will be transposed right to the 5-minute chart. You won't lose anything in case you're one in a lot of new people are afraid if they do something with the time frame, they'll lose their annotations. All right, so now we have this old high back here. Look at this price right there. Okay, that's going to be the high price. On that particular candle right there, it's 45.14 and a half. This candle trades to 45.14 and a half. Exactly the same high. When we have that, but look closer, we have relative equal high, but we have it in multiple short-term highs that keep going higher. If there's 3 highs that go up like that, that's a classic 3 drives pattern. There's a book I really enjoyed when I was in the 90s, Linda Raschke and Larry Connor's Street Smarts book. Really nice little book. I don't like everything in the book, but I liked a few of the things that they talked about. And it helped me understand stop hunts, because I couldn't understand it as a developing student, that why would the price want to go for those stops? It didn't make any sense, because the books that I had bought never really explained all that in detail. They just said, trust this pattern of continuation or reversal pattern. And the idea of stop hunts or raids on liquidity never really came up. So it was an alien topic to me. So when I started delving into the charts and started looking at it, it helped me. And the pattern that she and Larry mentioned in there was the 3 little Indians pattern. It sounds quirky, sounds a little silly, but it's basically the 3 drives pattern. Okay, that means it's a swing high, a higher swing high, and a higher swing high. So it's 3 times the market kept pressing up. I like to see this pattern forming when there's an old high back here, okay, on any time frame. It's universal, okay? But if you ever start seeing these 3 drives up into an old high, you don't have to see that 3rd high take out the old high, because what it's doing is it's already pressing into running out liquidity. Every time it creates a swing high and it starts to go down, bears are trying to sell that, and they're putting buy stops right above the previous high, and they keep getting taken. So it's already building in liquidity, and informed investors, or quote unquote smart money, will be already establishing short positions. Then the market breaks. In one of the previous videos, I talked about the pattern or the setup, and I suggested not using a particular swing low that looks like it's been violated, and why didn't that trade work out? Wouldn't that be a losing trade? I want you to think about this idea that I teach, which is displacement, okay? If you have a children's swimming pool, okay, you have a children's swimming pool in your backyard, and you fill it up, and then you have an elephant just fall down inside of it, what's going to happen? The water's going to be displaced, okay? It's going to be an obvious displacement of that water. rather simplistic analogy, but that's what you're looking for in price. When price goes above an old high and then trades down below it, you want to see an obvious displacement. You don't want to see it just do like, oh, you know, a little lethargic run here. That's not enough. This is like that elephant falling into that children's swimming pool. It's no doubt about it. It really had a displacement. When that occurs, then you go in and you start looking for the fair value gap. The low, the high, and if it trades back up into that, then you can look for a short, okay? There's a process that you go through learning it, and it's good that three of you were very critical about it, but trust me, there's rules for a reason, and I'm not trying to hide failure because these patterns sometimes will fail you. Okay, you'll read them wrong, or they just won't work. Okay, sometimes the market will have some kind of a news event that comes out, or it just simply just rolls over top of it and goes higher or goes lower. That's a losing trade. That's why you have to have a stop loss. That's why you have to have good sound money management, because if you don't have those things, Murphy's Law is going to creep in, and whatever can go wrong will. And if you leave it open to the market's determination how bad the pain's going to be, trust me, you don't want that. Okay? You want to limit that. So now we have this previous high, previous low. Now, if we did not, this is really important that you understand this part here. If we don't start seeing these higher highs forming, and it's just one steady run up, then you anticipate a high like this to be taken out. And it doesn't need to be taken out by much. Just trade above it. And then you want to look for this energetic movement lower. That's displacement, where it's really animated. So in other words, it would look like, when you look at your chart.
Yeah. असली स्टॉक मार्केट रिसर्च देखनी क्या होती है? अच्छा. This is my 150 book stock market collection.
That's a little bit more pronounced because it went above this previous high here. You're looking at this one, but as it's starting to move towards that old high, remember 830, prior to that, you're looking for, what's this? Is that a swing high? Yes. So it's trading above it here. Does it have an energetic break below that? No, it's just a very weak, anemic move lower. Then you have another run higher here. And then you have this wick or tail come down, and it quickly snaps back. Does that create a fair value gap in that? No, it's not there yet. Then it goes higher here. Doesn't go above, but matches that high. But then now this high, watch, does it go below that? Yes, a little bit here, but it's a little anemic still. But then look what we have here. It trades up and then smashes down. And the next candle here closes. What do we have? There's your fair value gap. That's your short. And you could reach for the liquidity resting below that level that you would be identifying prior to 830. So sell side liquidity matching up with your short. You sell, you want to buy it back to cover that short. Well, here's waiting sellers right down here in the form of sell stocks. And it's it. Okay. Putting aside that you may not have seen this as a long entry. Okay, maybe you didn't see this as a potential continuation of bullishness. But look at these highs here. What's resting above that now? Buy stop liquidity. And then what do we have here right before lunch hour? It goes slightly above it, and then it trades down, and then we're in that time of the day, you don't trade it. New York lunch hour, noon to 1, don't trade it. Okay, do not trade it. You can do a lot of weird things in that hour, or simply do nothing and go sideways. But either way, you don't want to get a participant in that because it's just, it's not usually a clean time of day for price action. So now here we have the high of the day, and all the liquidity resting above here that would not have been tagged by this. It stops the resting above that. Because there's a lot of people trying to sell short. They want to see this thing go lower. But we created a very important low last week, and the market has already tanked a lot. So it's pulling back up in the run that it created going lower on a daily chart. So all these buy side liquidity pools here are going to be a reason for the market to want to reach up to that. Because you don't have to be a participant down here as a buyer. You just need to know on the other side of lunch at 1 o'clock, start watching and see, is there an indication that this thing wants to go higher?
And as you can see, all the buy side liquidity here ran aggressively here, but then the market trades right into the close, aggressively bullish. Small little retracement here, small little retracement here, and then immediate run right into the close. And obviously the market trades a little bit beyond that, but this time of day, expect whatever algorithms you would expect to be driving price and price runs to pretty much cap the majority of the volume that's going to be in that day. So what I want you to think about is how the day's designed to have a morning mood, a lunch hour where you don't want to be trading, and then the afternoon mood. Go back through your charts, and you can go back as far as you want. The more you do this, the better you'll get. But I want you to think about creating your charts like this, and then describing what the morning trend was. Was it a bullish mood? Was it a bearish mood? Was it consolidation? If it was consolidation, prior to that part of the day, it's a previous day or the previous days, was it bullish or bearish then? Because if it was bullish, this is probably setting another continuation higher, especially if you start seeing these relative equal highs forming, where it paints the idea that this is retail resistance. So traders are going to think that this is going to go lower. And that starts to build up a lot more interest in the form of buy-side liquidity or buying interest at a high price. Even though those traders may be framing the context of their trades as a short entry, trying to make money going lower, their protective stop, if they choose to use one, it's going to be in the form of a buy stop. And this is where it's going to be at. So the market's going to want to gravitate towards that, especially if you start seeing the swing lows, not the one month time, ignore that one. You start seeing the swing lows that are forming. Every candle has a higher low to the left and higher low to the right. If they start building up, and every time they create a new one, it's going higher, that's a underpinning of the marketplace that's showing accumulation. It wants to go up because it wants to clean out all this here. Plus, we've been going up for a few days on the daily chart. Plus, the sentiment is everybody thinks it's been going down, so they all want to sell short because they want to see a stock market crash. But what they are failing to realize is we've already went down below an old low on the daily chart. So now we're running back the other direction, and anyone that's trying to sell short, unless it's a real quick intraday scalp, they're having their clocks cleaned.
Helps beat sensitivity fast. Expedite rapid relief.
So in the afternoon, there's a trend. And one of the built-in characteristics of the afternoon is there's mechanisms that are built in that help this market really accelerate into the close. And if you study the price action in the lower time, spitting out really, really aggressive pricing and forcing traders to either cover or get out of trades. And usually if it's going up, it really just ramps up and accelerates in that direction. So while I really enjoy trading the morning session because there's a lot of volatility and excitement, if you're looking for, if you know what your daily bias is, and we'll talk about that next week, if you know what your daily bias is, and if you know what you're looking for in terms of range expansion in the daily chart, and what do I mean by that? The daily candle, you expect it to trade higher or lower. You're not trying to predict, every single daily candle's close, but you're trying to determine, do you think that the daily candle you're looking at forming today, or what would be forming tomorrow, is it more likely to be expanding higher or lower? If it's expanding higher in your analysis, that means you want to try to trade with the expectation of find a trade in the afternoon based on the logic that was used in the morning. So in other words, think about what I taught in Forex. the daily range, okay, creating a initial high of the day and the low of the day here. Now, this is not the time of London, but this would be like what I teach as a London low in a buy day for Forex. This would be the low of the day. Then we consolidate, and then we get the New York continuation, and it runs in the same direction with the London session form. But this is not London. This is all New York time. So there's a little bit of adjusting that needs to be taken into consideration, which is why I made sure at the beginning of the video I said, make sure your charts are set to New York time over here. It needs to be that, okay? And if you don't have it like that, everything you're learning here, if it's at your local time, in your local time zone, it's going to be a mess. So you need to calibrate your charts on TradingView to that. And everything I'm showing you here is the same thing every day. Every single day, same thing. So back to the homework assignment. I want you to think about outlining what the session was in the morning, and then what did the session do in the afternoon. Sometimes what you'll see is it'll be bullish in the morning and then reverse in the afternoon. Or it'll be bullish in the morning and continuation higher in the afternoon. And you'll get like a measured move. What's a measured move? Whatever the morning move was, it'll duplicate that twice. So if it moves up 200 points in the morning, the afternoon could see another 200 points in addition to that and have a 400-point range. Or we get a consolidation in the morning session, and then it trends in the afternoon, higher or lower. Okay? And I want you to go through your charts and look at that on an intraday basis, do your charts like this. And I know it's a lot of work, but you want to learn how to do it right. And this is how you do it. Then study what the daily chart was showing days before, when it had days that had these nice runs like this, and yesterday and previous Friday. So it allows you to help find these big moves where if you're looking at other, like, I'm not going to say this to try to be mean-spirited, because that's not my intent here, but I want you to compare and contrast. Like, if you look around at all the folks on YouTube, and again, this is not me trying to be arrogant. I just want you to understand there's a stark contrast to what I'm teaching you here and what is predominantly shown in this area of trading, okay, index futures. You'll see traders that'll get in here and they get in at a price like that, and then they're going to make a big attempt to worry about a move like that. And they'll put lots of contracts on and, you know, trade this and have a whole lot of hype and anxiety about whether or not it's going to move in their favor and worry about their stop getting hit and all this stuff. And I don't want you thinking like that. Okay? I don't want you thinking like that at all. I want you to think about how, if this day was bullish for you, that you had the benefit of knowing that through analysis, you felt that this was going to go higher. Okay, if that's the case, this swing low here, first swing low in the importance after 130. This is really important. 130, I'm looking for swing highs and swing lows for the afternoon session. That's what I'm looking for. It's the same context that I used for the morning session. I'm looking for swing highs and swing lows prior to 8:30. I'm looking for the first one. Okay? I'm not needing to go back days and days and days. I'm just looking for the first one. It's not a complicated thing. But at 1:30, that's usually when I'm wanting to start trading in the afternoon. That's the earliest. But I'm preferably looking for a swing high and swing low to form at 1:30. Why 1:30? Because there's an algorithm macro that starts running at 1:30. That's beyond the scope of this mentorship, but just trust me, there is something going on that creates movement at 1:30 in the New York session, okay, in equity market. So when that occurs, all we're looking for, what I'm looking for, is a swing high and a swing low. And then that same basis of looking for a stop hunt in the morning, like we described here, I'm looking for the same thing here. That's it, same thing. So now think about this. I'm thinking that these stops are in jeopardy. This is too clean. The level's too clean. Straight line edges in the market, they don't tend to stay like that. There's going to be a disruption. The market's been going higher, hasn't it? Yes. There's this pent up.
फ्रेंड्स, अगर आप स्टॉक मार्केट में ट्रेडिंग कर रहे हैं तो क्या आपको पता है कि ये जो भी ट्रेडिंग हो रहा है
Aggression that this market wants to go higher, but it's seeing short-term resistance here, here. It tried it a little bit here, and then retraced inside the lunch out. The algorithm reserved the price run until later in the day. Now watch what happens. This swing low here gets violated right there. Yeah. That swing low gets violated right there. That small little stop hunt is all that's necessary. That will start what is called a buy program. A buy program is when the algorithms go into the process of spooling. Spooling is where it just continuously keeps offering higher prices. If it's a buy program, it just keeps offering higher prices. It does not matter what the volume is. It does not matter, and I don't care who you know, who worked at the exchange. I don't care. Trust me when I tell you, if you go through the charts, you're going to see this. Okay? Look at the volume that comes in. Sometimes it'd be good volume, and another, you're like, why is this happening? Right. That's your signature. That's how you know that this is being completely manipulated. So if it's being manipulated, doesn't it stand profitable for you to know what it's likely to do? If you're going to know it all the time, you're not going to not know it all the time. But these things tend to repeat. And if they repeat a majority of the time, not every day, but the majority of the time, if these things are in alignment, if they start showing the same fingerprints, it's probably going to pan out. And then you can start doing long entries and hold for the close. Don't get in here and try to trade these little Mickey Mouse moves and worry about them and over leverage and try to put more contracts on than your account can really weather. Because if you don't know what you're doing, cheap leverage, discount leverage can murder you. Can absolutely murder you, and especially in these kind of markets. They're very fast markets right now. I'm loving it, but it's very quick, violent volatility. And if you don't know what you're doing, you can literally be dismantled very quickly, expediently. Okay? So inside this area, the market creates a swing low, runs through this low, stop hunt. So the stops below here are what? Sell stops. Buy those sell stops. I know it feels scary, but go through your charts and you'll see many examples of this happening. Same thing took place over here. Buy the sell stops that are resting below here and expect this level to be taken in. Consolidation through lunch. After 1:30 in the afternoon, wait for a swing low to be violated, and then rally. What if you don't get a swing low that trades below it? What do you look for? Well, you look for a move higher that's sudden, displacement higher, then look for a fair value gap. If it trades back down to the fair value gap, you buy that. There's your two patterns. That's it. It's the only two patterns you need. You don't need 15 different gimmicky names, okay? You don't need breakers. You don't need an order block. How easy that is? Very simple strategy. Very, very simple strategy. You have a trade one way or the other, and the logic has to be there for either one of them to form. Now, I was not in the E-mini S&P today. I was trading NASDAQ. So let's go to NASDAQ, and I'm going to save time and not put all the lipstick on the chart so you can allow me that. But here is 130. We have a swing low there, and it's basically almost the same low as that one. So what's happening here? What's that? It's trading down below it. See that? Look further to the left. What's that? Fair value gap. It can't be that easy. It can't be that easy. These relative equal highs. What's
Hello, MJ. So the story is I just tried a lot of like a strategy, but I was not getting my desired result. You know, I was making profit and I am still above break even, but you know, that is not sufficient. If you want to just make this thing for the long run, then like just above the break even is not sufficient if you want to just make this thing as a career. And I was not getting a desired result. I've tried different strategies, but so I look for an strategy which is for the long, which is from the long time and having a lot of positive reviews. This is the reason why I decided to take this strategy, and I hope this will be my last strategy. Let's start our episode 6, because episode 5 we had not a lot of like new things. Episode 5 is basically the some sort of example of episode 3 and 4, like episode 2, 3 and 4. Just wanted to show the times where looking for the market shift and where is the order flow happens. Okay, so let's start the episode 6. Yep, so far so good. See, it is just my second day, so but I see it is not about liking or disliking. If you are able to understand any strategy and if you do your back test and if that thing works, then that's fine. If you like some if you like a strategy a lot, but if it does not work on the chart, then there is no need, like you will not going to like that strategy. If something works on the chart, then obviously you will be liking that. So in the in the 5 videos, I have learned about where I will be looking for the area of interest. Okay, different areas of interest, like a new high, clear high and low, or like old high and low, and sessions high and low. There we can see, we can look for a market shift. Okay, and in those market shift we can look for a fair value gap. So these are the things which I have learned so far. Let's move to the market efficiency paradigm and institutional order flow.
Folks, welcome back. This is episode 6 in our ongoing ICT mentorship on YouTube for 2022. And the market efficiency paradigm and institutional order flow will be our topic for this evening. All right, so how do we internalize price delivery? First, we do not trade patterns for pattern's sake. We do not trade indicator readings or momentum. We look to enter longs where retail sells. We look to enter shorts where retail buys. Usually when you hear me say something like that, or someone that's been trained by me speak like that, it sounds like, well, you know, you're talking like you work for an institution, you work at a bank, you know, you're trading retail too. Yes, we are all operating through retail avenues to get to the marketplace. What I'm teaching you is the internal dialogue of what we're doing when we're looking at price. We're not thinking.
Yep. Like the concepts are really good. I have already learned these concepts. Okay, so this is not a very new for me. Like, so far what I have learned from the ICT is like it is a like these all knowledge I have already learned these knowledge from other SMC courses. Okay, so right now I am not getting any new thing, but yeah, obviously I would say that the things which I am getting from ICT is a little, I would say, detailed, not different, but detailed, I would say. Okay. And also there are like, I've got a notes from other channel. So that's a very helpful thing, you know, because when you see a 1 hour video, it becomes very difficult to grasp all the things. And so many times I have observed that Michael just say a very important thing just in a line, and if you miss it, you miss it. So that notes is like very helpful. Okay, so I'm being the episodes, then I revise the notes, and then I move to the chart to just try to implement all those things. Okay, so that I can make a strong base. I have to do a lot of back testing because, you know, it is, see, when you look for an entry on 2-minute or 5-minute charts, so you must have a lot of confidence on the entry, because, you know, when I used to trade Gorilla strategy in the beginning, like when I did only 1 month of back testing, I used to just hesitate to take the trade. And now I can imagine that and there I used to take the trade on 1 hour time frame. But when you look for a setup on a 2-minute or 5-minute time frame, then I can understand that it is not going to be easy, you know, because after getting 1 or 2 losses, it is, you know, if you don't have like enough if you have lack of back testing, then you will definitely going to deviate from your strategy or from your plan. You know, in Gorilla, after a certain period of time, I used to like just take any trade. If it is okay, I will be taking. It doesn't matter I have taken 5 losses in a row or 3 losses or 6 losses in a row. I would definitely take that trade. Okay, so that confidence comes with the practice. Once you have done all the practices, definitely you will become good on taking the trades. Yes. I will be definitely, you know, whatever I will be doing, it will all on the stream. You know, whatever I will be doing, it will all on the stream. So let's see how it all goes.
Like the collective that is commonly referred to as the retail trader, because the majority of retail traders lose. They have a failed logic. They don't have consistency. They don't have, well, longevity. So we want to try to think and engage differently with price that is opposed to the majority of what retail analysis, concepts, whatever it is that you subscribe to as a retail trader. All those things, unless they're rooted in the basis of liquidity and overflow, it's made up. It's a religion. And I'm not here to argue beyond that. That's what I have come to believe. And that's how I operate. And my results and the things that my students see speak for themselves. We anticipate price seeking opposing liquidity. Okay, so what does that mean? Well, if you're looking at this diagram, imagine if we could take price as a conceptual idea. It doesn't matter what market it is, but let's just say there's two camps. There's the informed or smart money, and that's represented by this small little circle over here. And then there's a larger collective, which is the speculative, uninformed money. There's a large influx all the time of new uninformed money coming in because there's a large influx of.
Justly, I don't know why they are saying this. I can show you it on your. I can show this on their website. Let me just show you. This is written on their website. Just give me a minute. Yes. I'm just opening the site. I am opening his site. Just go to the blog section, okay, and here you will just, it was a September 2021 blog. Yeah, see, this is the thing. Yeah, just email this thing to them. Okay, this is a September 24th 2021 trading journal promotion. Okay, and there they have clearly mentioned that from the 1st October 2021 all the phase 1 and phase 2 evolution trader who will post their trading journey and journal on YouTube will be eligible to get their fee refund after passing phase 2 instead of after the first profit split. It is clearly written in their website. You can just give them just give this link or screenshot of this blog. It's clearly written on their site. Why would they not give you?
Uninformed money going out because they lose their account, they blow up whatever equity they have in their trading account, it's gone because of lack of discipline and a flawed logic. Smart money traders, when they look at the marketplace, they're not looking at secret trading indicators. Okay, there is no. Let me put that to bed right now. Now,
no problem, no problem. Yeah, they are not going to give you the profits, but you know, like if they give you that before the profit split, then also that is a good thing.
now there may be traders that have tools, okay, that they like to measure price action with. That's not like a stochastics. It's not like an RSI. It's not like anything you can find on a trading platform, list of indicators. Okay, those things are not reached for by informed money. What they're specifically looking at is time and price. The most important thing is time. Because time, that is the most crucial element. So time of day is vital when we're engaging price. Retail doesn't really have any understanding or affinity for time, except for the fact that they have time now to trade because they're in front of their computer, or they have time to look at their phone while they're at work and they're putting on trades. Okay, that's the extent of time when it comes to a retail average trader. Time for a professional, through the lens of smart money, time is crucial, because time of day, there are specific elements in a daily range that really build the likelihood of volatility to come in, and also when short-term reversals are likely to occur. Okay, so I mentioned in previous lessons that there's algorithms that will start to gyrate and cause price to run at specific times of the day. If you were watching the mini markets today, you saw it happen at 4 o'clock. That was one of the times I gave, and it was relentless today. Smart money, so that we have to make this real short and to the point. Smart money looks to cannibalize this group of traders. So because they're typically wrong in their directional bias, in their stop placement, should they choose to use one, because a lot of traders don't use a stop loss as a retail trader because they're afraid, they may expect the market to go lower. And they understand that the highs above where they're at, if they're in this very small window of profitability, unrealized profit, that means they're still in the trade, but they don't have a stop loss in. Now, logic dictates that they should have a buy stop in to protect their position in case the market screams against them. At least it limits the amount of equity loss. But they may look at an old high and say, okay, I understand that my stop should be above that. But because of their infancy, they have no idea where to put it above that high. They don't want to put it too shallow because it might go there and hit it and stop out their trade prematurely. Or they don't want to put it up too high and then it spikes through that and reaches for them, and then it reverses and goes in the direction they're holding. So they take a big loss and get stopped out. So those are the two conundrums that a retail trader falls in, to that pitfall, that trap. And maybe you're nodding your head and smirking, thinking, I was there a lot.
Like here, just by this last point, what I am concluding that it is important to just take the trade when there is liquidity, when there is volatility in the market, like a New York Open or London Open, So those these are the things which, like, Michael is trying to say, or looking for a market structure shift on the volatile time when the momentum is there. If there is no momentum in the market, then there is no need, like, no matter how good you get the setup, if there is no momentum, the market is not going to anywhere. And the momentum thing comes only when we are having a certain time, like certain times, like London Open, if you look pre New York session, okay, or like equity market open. So in those times we get the momentum, and and also the thing is, like, see, the momentum thing is also, if you go to the charts, if you go to the chart and just go to a 15-minute, so the timing aspect is crucial, because if you mark your London high, so this is our London high, okay, or this is our Asia session high, and this is our Asia session low. Sorry, what I am doing. Okay. That is a different thing. That is different.
I know, and I can admit, back in the 90s, 1992, 1993, That was what I was doing all the time. You know, I just didn't know what I was doing, and I was falling victim to myself and just infancy, not knowing. But the smart money traders are not looking at price with give me a pattern to trade off of, you know, bull flag, a wedge pattern, something to that effect. They're looking at liquidity. What is the underlying narrative right now in the marketplace? Is it bullish? Is it bearish? Is the daily range going to go higher? But how's it going to go higher? Is it likely to go lower at the beginning of the day first to sucker traders in going short? Run out, sell stop. They can acquire long positions at, and then rally going into the close or maybe into the afternoon. And that would be the extent of their plan of action. And how does that speculative uninformed money and its liquidity that it provides, how can they utilize that? That's the market efficiency paradigm. It's efficient for smart money traders to view the marketplace in that perspective versus technical analysis, the mumbo jumbo things that traders put on their charts. Okay? And you can lump me in there too, because the times where I'm trying to use the logic that I trade with, and if it fails, I've done something wrong. I've interpreted price wrong.
See, with this sort of strategy like ICT or SMC, the most difficult part is to do the backtesting, because you cannot go like a 6 months or 1 year data with a 1 minute or 2 minute time frame. It becomes difficult. So when you do analysis on like what is the name of that MT4 for MT4 simulator, soft effects, when you go there, that is not a that is a very old version. They should update it, but there are lots of things like which is missing in that software, and it becomes very difficult when you do backtesting with that software. No, so that is the most difficult thing which I find, because if you are having a lack of backtesting, then it becomes very difficult to understand that strategy or get the confidence on that strategy, or on that concept. So it becomes a little difficult, but yep, it is not impossible. It is not impossible. It is difficult, but not impossible, I would say. It may take some time. It may take some extra time, but yep. If you are determined to do the backtesting, then you will definitely be able to do it. And for me, I would say that like minimum, I would say 2 years or like 1 year of backtesting is like 1 or 2 year of backtesting. I would say 2 year will be sufficient. 2 year, 3 rounds of 2 year, one pair. 1 pair, 3 rounds, 2 year. Then go to the live market. I know it will take a lot of time. Not a lot of time. See, if you are consistent, you can do this thing in just 2 months maximum. 2 rounds or 3 rounds of 2 year. It will just take 2 or 3 months. In between 2 or 3 months, you'll be able to do the backtesting of 2 years of data. And after doing that sort of backtesting, if the strategy is good, then you will be definitely, what I learned from the Gorilla. See, strategy, I would rate it around 6 out of 10. Okay, Gorilla strategy 6 or 7 out of 10. But if you ask from me like how to learn any strategy, I learned that from Gorilla. How to learn the forex strategies, I get that thing from GT. But how to how to study the concepts, how to do the backtesting, and when to apply that thing on the chart, all these things I learned from there only. Because before joining to Gorilla, I was like, okay, I know certain things, but backtesting thing was never in my mind. Backtesting, I used to like, it is a very underrated thing. And if you ask from me, back testing is the most important thing. It is not like just because back testing just you are repeating a thing again and again. If you will repeat one thing again and again, it will become your second nature. Once it will become your second nature, no matter how much pressure you have, you will be definitely do that thing, because that has become your second nature. This phenomena occurs when you learn driving. In the beginning you will be looking at your brakes, your handle, your mirror, your gear, but after like 6 months you don't have to watch all those things. Your main focus is, you don't even think about to just park your car. But in the beginning you will be taking like 10 minutes or 15 minutes to just park your car. So the same thing, because practice. And this is the reason, and I think that this is the most like important reason why most of the traders fail with lots of strategies. No, I don't say that SMC is the best strategy, or GT is the best strategy, or break and retest or Raja Bank's strategy is the best strategy. But the thing is, if you have not practiced that strategy enough, it will become difficult for you. For this strategy, I have planned to do a minimum 3 rounds, 3 pairs, 3 rounds. My plan is to just do a 3 pair, 3 round, 3 pair, 3 round. Okay, and 2 years. It will be a back testing of somewhere around, but yeah, I'm not going to start the back testing just I finish the content and just I will be start doing the back testing. No, I'm not going to do like that. But once I will be completed the content thoroughly, I am having like all the I have learned all the concept by heart, then only I will be I will jump on the back testing. And my back testing will be somewhere around 2 years, 2 year of Euro USD. It will be 2020 and 2021. Okay, Euro USD, GBP USD, and the third pair will be, I think, I'm not decided yet. It will be either US 30 or NAS 100. I will be doing this NAS 100 or US 30. Okay, so GU, EU, and NAS 100 or US 30. 2 years of, so I will be doing a complete in 1 round. I will be doing a back testing of EU round 1. It will be somewhere around worth of 3 round of, let's suppose 3 round of EU. It means 6 years of data. 6 years of data. Okay, each round 2 years, then 6 years of data. Then GU, so 6 years of data, and then US 30. So it will be also somewhere around 6 years of data. So if you've done this thing, like it will be approx 18 years of worth of data. Okay, like round 1 2 years, round 2 2 years, round 2 2 years. So it will become 6 years of Euro USD, 6 years of GU, and 6 years of US 30. Okay, I will be just looking trades in between these, like in between New York session. I will not be looking any trade. Like, I'm having a plan that I don't want to sit before the New York or after the New York. So I will be just sitting for 3 hours. No, and that 3 hour will be 5:30, like 4:30 to 7:30 or 5:30 to 8:30. So I will be just doing the back testing of that particular price action. You know, so this is my plan. Let's see how much time does it take. In the first round, I know that when I will be doing the first round, I will be having a lots of error. I will be taking lots of unnecessary trades, lots of mistake. I remember that when I was doing the gorilla strategy also, in the round 1 in Euro, see, gorilla strategy, we don't have lots of, like, we do have discussion, but we have less discussion than like SMC or ICT. No. So in the first round, I remember that I used to take a lots of like entries which does not fit my plan. Okay, but round 2 it started decreasing, and the round 3 it just completely, like, it was just refined. So this is the thing I have thought before going to live, before using this strategy live, you know. Let's see how it goes, how much time does it take. But you know, if I will be consistent, like if I will be doing this consistently 3 hours per day, okay, I also, like, it is not just 3 hours per day, I also give, like, let's suppose 3 hours after the live stream also. Before the live stream 1 hour, 1 or 2 hours, after the live stream 1 or 2 hours, so it becomes like 6 hours. But after, when right now my college is off, so when my college will open, it will become difficult for me to give 6 hours, but I will definitely giving it 3 hours. And you know, right now I'm learning the concepts. When you are learning the concepts, you need time. You know, you need time to learn, to watch the things again and again. You have to do a lot of like chart work. You have to understand the concept. But once you understand the concepts, and once you just have to implement those things on the chart, then it will become you know, then it will not take that much of time. Then it will be just taking like 2 or 3 years, like hours per day will be enough.
Something was in price and it wasn't there, and it rolled over the top of it, and there it is. That's a loss. Everybody's going to have a losing trade. Okay? But I'm not looking at price with patterns on the sake of just trading for the pattern's sake. In other words, just because I think I see a pattern there, because there's a misnomer that goes around, trade what you see. Well, just like the trend is your friend. That trend is not your friend when it's at the end and it's reversing. Okay? So there's always a rule to the rule. There's always an exception to every rule. Okay? And that's experience. But what I've hopefully done in this model so far, and I promise this is the end of the boring stuff, we'll do some nuts and bolts. I'm stripping everything down and placing components at their logical place and order, so that way you can go into price immediately. You don't need 18 months. You don't even need 4 months. It's immediate. I've received a ton of feedback, and I appreciate all that you all can go into the charts and see these things right away. And some of you actually started trading them. I'm not asking you to do that. I'm not trying to inspire you to do that. You need to study it more. But that's how quick and different all this is. Okay, this is not your typical ICT, you know, the stale, boring stuff. This is the things that really work in the marketplace. So with that in mind, let's continue.
Rajnath, have you done real trades?
Yeah.
So come here. Thursday को end में लिया था. Can you show?
Yeah.
So I want to give a little bit more specifics about the fair value gap. That way you have the rules, what it looks like, so that way you understand exactly what it is and where it forms. Because this is going to repeat every single time. It's going to be the same logic that I'm going to show you here. Okay. Do not try to fancy dance this, okay, and try to turn it into some kind of a mentorship course and rename everything with your name, and don't do that, okay? Just take it for what it is. I already know people are going to try to take this and copy it and make courses out of it, okay? I've already given it to you for free. If it helps you, then God bless you. Okay? And all I'm asking for is just appreciate the fact that I've taken the time to put it out here for you. So the bearish ICT fair value gap. This is institutional order flow. And it's a pattern that you can see the order flow actually coming into the marketplace. When you look at like depth of market, okay, or if you study volume profile, that's a religion, okay? What you're looking at is data, yes, but your interpretation is a private interpretation. It's what you believe. There may be a lot of other traders that have a similar mindset about that very thing, but simply because you think that doesn't make it true. It doesn't, okay? So what I'm trying to do is take my students into the marketplace with a chart, a time-based chart. Okay, there's some out there that will say time-based charts are useless. That's because they don't know how to use a time-based chart. Because algorithms, the first element they operate under is time. Hello, once. So we're looking at what does a bearish ICT fair value gap look like? Well, if you take a look at this diagram, it's rather crude, I know, but you have a run preferably above some kind of old high. So the first candle is the high, and the next candle is the extended low that goes below it. And the third candle is another continuation candle, but the main important factors are this. It's a 3-candle formation. The first candle's low has to be traded below on the immediate following candle. The next candle has to trade with an extended low as well that went below candle number 2, but does not trade with a high that trades back to candle number 1's low. What that creates is this small little gap where one candle only traded from the range of the candle number 1's low to candle number 3's high. So that little space that's occupied right there, what is actually occurring there is price is only being offered on the sell side there. So imagine if you're painting your wall at your home, okay? And you take your roller, you put it in the paint, and you put the paint up against the wall, and you roll down, okay? At first, the first foot or so, there's going to be an ample amount of paint delivered to the wall from your paint roller. But then as you keep rolling down towards the floor, what will happen? You'll start seeing these little pockets that look really porous, okay? What do you have to do to fix that? You just change directions and start rolling the paint roller back up, the same place you roll down. That's exactly what price does. There's an algorithm that delivers efficient market delivery. You can argue with me all you want. You're not going to convince me I know it. If you go into price action with that market efficiency paradigm perception, of looking for this characteristic in price, I promise you, you will never look at charts the same way again. It'll unlock a lot of things. Remember the movie The Matrix? And Neo finally sees the Matrix as it really is in binary code, 1s and 0s. He has clarity. Well, that same event, as silly as it may sound, ends up happening when you look at price action, when you start looking at it from this perspective. So let's go back into the analogy with this. Between this candle's low and this candle's high, we only have sell side offers. So that's like taking the paint and applying it to the wall and drawing down with the roller. But now, as you pull down, there's little pockets right in here between this candle's low and this candle's high, where price has not been efficiently offered for buyers. Why? How's that working? Well, you have sell side being offered here because the market's delivering lower prices. It's offering continuously lower prices between this candle's low and this candle's high. To efficiently balance out that little inefficient area, at some future time, the market's going to want to trade back into that area. When it does, and you're bearish, that's a short signal. Okay, you can go short and sell there with the expectation it's going to start to move lower. Optimal formations of the bearish ICT fair value gap will be found after a run into buy-side liquidity. So it's not a matter of going into charts and looking for this little gap all the time. This model I'm teaching you on this YouTube channel is meant for you to look for periods where the price runs above an all high. Then it breaks down, and then you look for this pattern. This is what it looks like. You're not looking at anything prior to this candle. Has absolutely nothing to do with anything except for the fact that it's been trading above an all time. That's a very simple logic, isn't it? And the run above a single high or multiple highs, like a double top, okay? Either one of those fits this criteria. So what you're looking for is a pool of liquidity of buy stops. Resting above these highs, that's buy side liquidity. Smart money will want to trade up into that and go short. They may not be engaging above the high. They may miss it, just like any one of us that haven't been ready to take an order and place it in the marketplace. They may miss that. This is their saving grace right here, this pattern. That's what smart money's looking for. They're looking for that right there. And then once they see that, they go in, either with their limit order, mark it in, something to that effect, and get short, and the stop would be above the high. Okay, there you go. Short and sweet, done. That is exactly what you're looking for a fair value gap. So when you're doing your annotations on your charts, this is what you want to be doing. All your back testing, label number one candle, the number two candle is always going to be where the gap resides. And then the number three candle gives you the lower end. The upper end of the fair value gap is going to be the low of candle number one. The lower end of the fair value gap is going to be the high of candle number three. And the difference between candle number one's low and candle number three's high, that's the fair value gap. So the easiest entry would be trading just above candle number three's high. You can put a limit order right there and be done. It's simple. Don't have to worry about guessing where to put your limit order in. It's right there. Place your stop right above candle number one, or you can put it above candle number two. But while you're learning how to use this, that may seem like a lot of range. You want a lot of range when you first start out. I'm assuming that all of you are brand new. You may not be, but I'm teaching it with that perspective in mind. Some of you that have been with me for a longer time, you know how to reduce that stop. And I know hearing that by some of you that are new, you feel like you're being slighted. Oh, you're holding back. No, I'm protecting you, because I know already some of you already are going out there trying to trade live money, and you may be reporting you're doing good, but you don't know what you're doing yet. Okay, just trust me. You got to practice and do a lot of back testing, then demo it. Then you'll get it. The bearish market structure shift. What does that look like conceptually? Well, you have the market trading higher, short-term retracement, then it trades above an all high, or the initial short-term high that it trades above here, and then it breaks down. Once that low is broken, that's when the new trade idea is now being birthed. You don't even know where you're getting in at yet until you go through this process I'm going to show you right now. The market will see a price delivery of a rally above an old high or highs, and then quickly shift lower. That's this right here. Now the significance I'm placing on the term quick is linked directly to the term displacement. Okay? It's got to be energetic. It can't be a little lethargic little move. It's got to show a real willingness to want to go lower, and preferably close below that. If it does that, that to me is a little bit more significant. Whereas if we just go through this low a little bit like a wick and come back up, that to me is not all that convincing. I want to see that it has absolutely displaced, and then the candle closed, and then we look inside this range here. So when you're looking at market structure shifts, this is all time frames. So don't think this is just the intraday version of it, but I'm specifically dealing with intraday. So when we create that high down to the low that breaks the short-term low here, so now we have that shift in market structure there, right below that low. That is the displacement low. This is your displacement high. So what's the big deal about that? Well, you're just trying to add some words. ICT sound smart that way, don't you? No, it's conceptual ideas being expressed. So what you have in between that range, that right there, you're going to be hunting your fair value gaps because that's exactly where it's going to form. Don't take my word for it. Every one of your examples are going to have this. Don't take my word. It's the only thing to believe. Go into your charts and you will be convinced of it in short order. Period. So if you're bearish and you see price run above old high, then it breaks below the old high and takes out a short-term low prior to that run above. That short-term low being broken, draw that out in time, that's your displacement low. And the high is your displacement high. So that range between here and here, that's displacement. How do you know it's displacement? How it closes down here below that low. Is it just a real short little drop below value gap? But it also might be.
So here an important thing which I noticed, that the market shift which the ICT is telling us, the market shift must be a very sudden market shift. You know, that market shift should not be a small candles. Like let's suppose we are having a intraday. Let's suppose we are having an intraday before equity market open. So equity market opens at around 9:30, or IST. If I look at the IST time frame, so equity market opens at around 7 p.m. IST. Okay, so we mark the highs and lows before that. And when we try to go to a lower time frame, this is our low and this is our high, okay, before the equity market open. And if we see the market we can just see that the market has formed a structure at around this area. Okay, market came down. This was the structure. So if I want to take a trade, the trade must be, so it must break this structure. Okay, it must be like this. Once we get the break structure, we will be looking for a fair value gap in between these areas. So this sort of candle which the Michael trying to teach, like that candle must be very bullish. Now that should not be a very easy candle. If we looking for a distance, that price should not move like this. If you want to see a break of a structure, that should be that must be a very quick candle like this. This 5-minute candle is, I would say, a quick candle. Okay, and then we get this candle which came down and just moved up. So now the market break the structure, and now we are in a, once the market has broken this structure, we will be looking for some sort of fair value gap, okay, on a 2-minute or on a smaller time frames. So here I cannot see any sort of fair value gap. The market again came down. Okay, we don't have any sort of fair value gap right here. And now the market, when continued its move to the upside, we are having some sort of fair value gap at around this area. Okay, you can see we are having some sort of fair value gap at around this area. Before it, I don't see any sort of fair value gap. Market just rebounds from the intraday low before the equity session open. Okay, market break the structure with a nice momentum to the upside. Hit trace, but we don't have any fair value gap, and then the market again started continuing its move to the upside. Now we have some sort of fair value gap. So according to Michael, we can take this trade. Stop loss will be below it because this is some sort of order block. We are having our order block. Okay, so if I want to take the trade, my stop loss will be somewhere at around this area, and then I got tagged in. Believe me, I did not remember that the market is going to retrace. I have seen this price action in the starting of the video. I just try to look at this price action, but I did not see it as like we had a fair value gap at around this area and the market is going to reverse from this area. Okay, so that is a good thing.
Likely to go higher and create another high. So this is the secret to it here, knowing how we trade below that, and if it's energetic, a lot of movement, a big beefy bearish candle that closes low, below this level right
So
here.
we also get our fair value range just on, if you look at the chart, we just got that fair value range into this displacement area. So that is also a good thing, which is like, you know, I'm just trying to look at all these things. So this is our displacement area, so we get that fair value gap inside that displacement area. So it is a nice thing, you know. I'm just trying to see all these things,
If you have
whether it
that,
is
so maybe
relevant
we
on
have
the
that
chart or
candle
not.
form. Start watching to see if it creates a fair value gap in between this low and this candle's high, or that range. Okay, that's exactly what a fair value gap to sell short will form. If there is no fair value gap in here, guess what? You don't have a trade. You wait or go to another market because one of them is going to be there. Every single trading day, okay? Every single trading day, this pattern forms. Are you telling? Yes, I'm telling you just like that. Every single trading day, this pattern forms. Every single day, long and short. But you have to look for it with this process, okay? Everything I teach obviously is reversed the same way, so I'll just go through this a lot quicker because it's already kind of a long video that I'm going through. But bullish ICT fair value gap.
Javed, right now I'm not like trying to look anything. I just want to just see whether these things are like working or not. I will, when, you know, this is just my second day of learning ICT, so you cannot expect me that I obviously I will be confused. This is just my second day. Obviously I will be confused if I just go to the chart and try to locate anything. But right now I just wanted to, because I have already learned the SMC, tried to learn the SMC, so I know some of the concepts. Okay, and I know it is very confusing, you know, to get the point of interest, or like, you are absolutely right, Javed, but it will take time. I will be doing a lot of backtesting, and all those backtesting will be on live. So let's see. Any new strategy is very confusing, believe me. You know, when I started doing guerrilla trading, guerrilla strategy, I was very confused to mark the high and low. And after like 3 or 4 months, if you ask me if I am in a sleep and you just wake up me and ask me to just mark high and low, I will be just marking that. even if I am a half sleepy, you know. So in the beginning, the things are very confusing with any sort of a strategy. But with the time, with the back testing, I know that these things will definitely start working.
Again, institutional order flow pattern. It's 3 candles formation. The candle here is number 1, the second candle here, and the third candle there. Candle number 1's high, that is the low of the fair value gap. Candle number 3's low is the high of the fair value gap. Candle number 2 is where the fair value gap will be formed. So that is your fair value gap. Everything you would expect to see in the form of a market run below no low or multiple lows for sell side liquidity. Once it starts trading higher and takes it out a short-term high, that's not being shown here. Okay, so I'm showing you the pattern itself. This is what you're looking for. Okay, this separation between 3 candles. That's the criteria. You have to blend in the logic of a market structure shift that's bullish. So what does that look like? You have a market trade below no low, and maybe go another leg lower and create a run into sell stops. Once that occurs, then you're looking for a run higher. It takes out the short-term high, and it closes above it with an energetic displacement higher. Once you see that, then you have a trade idea being burnt. You don't have a trade entry yet until you determine if it has a fair value gap. Where does that reside? Between the displacement high and the displacement low. In between, right before the market structure is broken bullishly, and the low that ran into the sell stops, that is your range. This is exactly where you're looking for a fair value gap. So in that range, that's where your bullish fair value gap resides. If there isn't one there, you don't have a trade. Is that not specific and clear? It's perfectly illustrated. There's no ambiguity to it. It's exactly the logic you're going to use. Going forward, it does not change. It doesn't mutate into anything. You don't bring something else into it. You don't add something else that some other educator's taken my stuff and twisted it up and tried to make it sound like something new and they've created themselves. No. This is what you're supposed to be doing. If you do anything other than this, you're not going to get the results you're looking for, and you're not going to find my ICT fair value gap. Okay? You survived. You made it here. So here we have the 15-minute time frame from today. This is the E-mini NASDAQ. And this is the 15-minute time frame. This is where I took.
Okay, I'm just wrapping this session at this point because I have to go to a birthday party. So I'm just stopping the video because, you know, I don't want to be late there. If I would not have to go anywhere, I would definitely complete this video, but as I have to go, so but today I will be just finish this video, and I will try to just make the notes by my own, and I will also try to make some chart work